Good morning and welcome to the TOPPS PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Rob Parker, CEO. Good morning to you, sir.
Good morning. Thank you, Alessandro, and good morning, everyone. Very warm welcome to the TOPPS Group half-year results presentation. As Alessandro has just said, I'm Rob Parker, the Chief Exec, and my colleague joining me here today, Stephen Hopson, is our CFO. So if we turn to our running order today, so I will start with some highlights from the business over the first half. Stephen will then talk us through our financial performance, and then I'll come back on to talk through the operational activities of the business. So starting firstly with, really this page is designed to give us a view of the group at a glance. So the TOPPS Group is actually a multifaceted business. We operate across three platforms. Our market-leading omni-channel domestic specialist, which is TOPPS Tiles, I'm sure will be very familiar to all of our viewers today. And then outside of that, we've also got a range of brands operating within our digital pure play market. We'll come on to those in much more detail. And our commercial-facing business, Parkside, which serves more of an A&D architect and design community and the commercial market in the UK. All of those things very decidedly pointed at our overall goal for the group. We've got one very clear goal, which is what we call 1 in 5 by 2025, and that is a market share-based goal. So it's about achieving a 20% market share of the entire UK market for tiles and also other closely associated products that we sell, so things like adhesives, grouts, trims and tools. So we want to achieve a 20% market share of the entire UK market. That gives us a total addressable market of about £1.25 billion in the UK, and we want to get there by 2025. We're actually currently performing very well against that. It's about 19% share at the end of last year, and we think there's a very good chance we may achieve that goal earlier than we originally planned to. In terms of highlights for the first half specifically then, we've delivered a record ever period of trading for the TOPPS Group, so record ever 6 months with sales at £130 million. Stephen will come on to that in a little more detail. And that it has also come off the back of, and I'll just pause for a second while we get some slight disruption this end. If you can hear that, that's our sandwich van local to the office. I apologise. So a record period of sales for the group, and that comes off the back of 2 record ever years of turnover for the group as well. So demand has remained very robust, I'm pleased to say, across the UK consumer. The TOPPS Tiles business itself has also recorded a record ever first half of sales, with like-for-like growing by about 4.3% over the first half. The Pro Tiler business I mentioned on the previous page, or was listed on the previous page, Pro Tiler business we acquired in April 2022. That's continued to perform very strongly during the first 12 months of our ownership, and that business in itself is growing by about 40% year on year. We'll come to that in more detail. We have experienced quite significant cost pressures over the first half as well, in common with lots and lots of businesses. Those pressures are now starting to abate, which is very positive. And particularly things like supply chain and employment pressures are easing from some of the peaks that we've seen over the last 6 to 12 months. On that basis, we do expect to deliver a materially stronger second half profit than we've seen in the first half. There are some good reasons for that, some very clear reasons which Stephen will cover. And we're also we remain very confident in full year expectations for the business. And that goal I mentioned on the previous page of 1 in 5, our 20% market share goal, we do think we're going to get there early. Actually, there's a very good chance we think we could get there by the end of 2023, which would be 2 years ahead of the original timescale we set ourselves. So that concludes my sort of introductory comments. I'll hand you over to Stephen to run through our financials.
Thank you very much, Rob. So I'll go through the P&L first of all, and then I'll touch on cash and the balance sheet, and I'll do some sort of forward-looking stuff at the end of my slot. So if we start with looking at the P&L, so this covers the 26 weeks to the 1st of April 2023. And the comparative period from last year to April 2022, as Rob mentioned, we did the acquisition of Pro Tiler right at the end of that period, so the structure of the group is a little bit different this half compared to last half, which I'll talk to in my future slides. But in terms of the numbers themselves, sales are very strong, plus 9.3% year on year, up to £130 £8.3 million. As Rob said, that is the highest period that the group has ever delivered in a 6 months period, so a record period in terms of sales. Gross profit was up 2.7% to £68.7 million. Gross margins were down 3.3 percentage points, and I'll touch on the reasons for that in a couple of slides' time. Operating costs were up 7.4% year on year, with the major factors here being cost inflation, as Rob mentioned, and then the addition of the cost base relating to that online pure play business, which weren't in the numbers last year. Again, I'll show that in a few slides' time. And all of that led to profit before tax, adjusted profit before tax being £4.4 million. That was in line with our expectations, and we are confident of a much more profitable H2, which again I'll come back to later on. I've now got a couple of slides looking at each of the key lines on the income statement, which I'll go through one by one. So if we start by looking at sales, the way this chart works is that the sales last half one were 119.2 million, this half one were 130.3, and then the bridge sort of walks between those two numbers, showing the impact of each of the different businesses. The numbers beneath the table are the actual sales delivered by the business in each brand. So, for example, TOPPS Tiles delivered £115.8 million in H1. So starting with TOPPS, like-for-like sales were 4.3% up year on year, pretty similar growth in Q1 and Q2, and actually also pretty similar growth going into the start of Q3, so that was quite consistent. And the level of sales growth in TOPPS was quite impressive, particularly when you consider that in the same period last year, so the comparative period, TOPPS Tiles grew its sales on a like-for-like basis by 22.7%, so sort of growth on growth within the TOPPS Tiles brand. We did have slightly fewer stores than last year, which reduced sales by £2 million, and therefore total sales growth in TOPPS Tiles was £2.7 million compared to last year. Parkside, our commercial business, saw sales fall £0.4 million to £4.6 million. And then online pure play, as I mentioned, not really in the numbers last year, but this year delivered £9.9 million of sales to the group, taking overall sales to £130.3 million, which was the highest 6 month period that we've recorded. Turning now to gross profit and gross margin. So starting with gross profit, GP stepped forward £1.8 million compared to the first half last year to £68.7 million. That is also actually another record period for the group. That's the highest H1 that the group has ever had in terms of delivering gross profit at £68.7 million. Gross margin expressed as a percentage of sales stepped back 3.3 percentage points to 52.8%. And there are really three things to pull out here. First of all, the different businesses that we now have in the group have very different gross margin structures. So TOPPS Tiles versus Parkside versus the online businesses. And in particular, in this period, the very, very fast growth in the online businesses, which have gross margins of around about 30%, reduced the group gross margin by 2.1 percentage points. It's a really important point here to note that all the businesses in the group have the potential to deliver 8 to 10% net margins. It's just the structure of the gross to net margins are quite different by different business units. Secondly, the rather volatile path of the pound over this period led to unusually high impact from FX. This 1% movement is down to two things. Firstly, the mark-to-market valuation of open forward currency contracts, and secondly, retranslation of monetary items on the group's balance sheet. And then finally, the change in business in gross margin within each business, so within TOPPS, within Parkside, and within online pure play, was relatively immaterial at 0.2%. My final point on this side is that we fully appreciate that the gross margin within TOPPS Tiles has been on a bit of a downward trend in recent years, but actually, and this is an important point, the gross margin in TOPPS Tiles troughed in the course of H1, so started to grow again as we reached the end of H1. And we are confident that H2 in TOPPS Tiles will be stronger again as the margin continues to build. And we'll talk about some of the things on that as we move forward through the presentation. Moving to operating expenditure. I mentioned earlier that OPEX costs were up 7.4%, and it's up 7.4%, a slightly lower level of increase than the level of sales growth, which was 9.3%. And again, there are three big factors to call out on this chart. The first is cost inflation. Overall cost inflation was about 5% in the group overall, and a big chunk of that was gas costs, which were up £0.6 million year on year, and then the rest was across the cost base of the business, so things like employment costs, rent and rate inflation, and central contracts and so on. Partially offsetting that, we did have some savings. I mentioned earlier we had slightly fewer stores in TOPPS Tiles, about 10 fewer stores on average across the first half. That generated cost savings from the removal of the cost base associated with those stores of £1.1 million, half on half. And then finally, the addition of that online pure play business wasn't in the numbers last year, it is in the numbers this year, and therefore the cost base associated with that grew the group cost base by £2.6 million. In H2, some of the inflationary costs will increase, like our gas expense, and some things will reverse entirely. So we have a holiday pay accrual, which will reverse in H2. I'll come back to that on my forward guidance slide in a moment. So bringing it all together and looking at profit before tax this half compared to H1 last year, the group delivered strong profit growth based on gross profit increases of £3.2 million, but that was offset by £1.3 million of negative FX movements, inflationary costs across the business, and then the inclusion of the online pure play cost base that wasn't there before. And those were more than the benefit that we got from reduced stores, and therefore profit was £4.4 million in H1. Profit is expected to be materially higher in H2 compared to H1, and again I'll talk to that in a second. Before I do, to finish off the half one story, I'll just touch on cash and balance sheet. So we had a good performance in terms of cash flows in the first half. The business is strongly cash generative, and overall cash moved forward from 16.2 million at the start of the financial year to 19.9 million at the end of H1. This chart walks through the building blocks of that. The first thing is that the operational cash flows of the business were good, so £8.8 million increase from operational cash flows. And that was really because the actual profit in the first half was impacted by a variety of non-cash items, such as those losses on FX contracts that I spoke about, the holiday pay accrual and so on. And so actually cash flows were stronger than profit in H1. Secondly, we had a working capital benefit, £4.2 million inflow in working capital that was based on higher trade payables and a higher VAT creditor. We spent £2 million on capex in the first half, which is lower than our depreciation charge. Interest payments were basically zero, and we paid about £2 million of tax in the first half. So therefore, even after an increase in our dividend, so we paid £5.1 million in the first half relating to our final dividend payment from FY22. Even after that, cash flow stepped forward to £19.9 million. For the first half this year, we've declared an interim dividend of 1.2p compared to 1p last year. That interim dividend is set at 1/3 of the prior year's full year dividend, which is in line with the capital allocation policy that we announced 1 year ago. And then finally, the group's balance sheet remains very strong. So as it says on the slide, about £20 million of cash in the bank. We've also got a committed but unused £30 million banking facility. And so therefore, in total, we've got about £50 million of cash headroom in the group. My final slide is sort of looking forward, really, and in particular, I've spoken a couple of times about why we think H2 is going to be materially stronger than H1 from a profitability perspective, and the top 4 bullets in this chart detail the reasons for that. So I'll just walk through them. The first one is, I mentioned earlier on that gas has become a material cost to the group. Before the current energy crisis, our annual gas bill in the group would be maybe £300,000 or £400,000. This year, the gas bill will be about £2.4 million. But that cost is weighted towards H1, which are the autumn and the winter months in the calendar. We use gas primarily for heating, and therefore, the cost is much higher in the colder periods of the year. So the gas bill in H2 will be about £700,000 compared to £1.7 million. Therefore, a swing in the second half of more profit, about £1 million relating to that. Secondly, we have to accrue for holiday pay, which is earned but not taken. More people earn holidays in the winter and then take them in the summer. So therefore we have a cost in the P&L of £0.9 million in H1. That fully reverses as a credit in the P&L in H2, therefore giving a positive swing of £1.8 million of more profit in H2 than in H1. So those two factors alone will deliver £2.8 million more profit, even if nothing else changed in H2 compared to H1. Thirdly, I mentioned earlier on that gross margins are trending higher in TOPPS tiles, and we expect them to be higher in H2 than H1. And then finally, the new businesses in the group, particularly the online pure play parts of the group, is growing fast and is expected to contribute more profit to the group in H2 than in H1. So overall, those factors give us a really high level of confidence that we will hit market expectations for the full year. The rest of the points on that slide are more general information about forward guidance, which you can read at your leisure. So I think at this point, I'll pass back to Rob.
Great, thank you, Stephen. So on to the operational review for the business. I'll start with the strategy for the business. So the strategy is obviously based around growth in order to deliver our goal of 1 in 5 by 2025, I mentioned at the start. And that growth really is hinged around our two core specialisms for the business, which are our products, leading products and leading people. So leading products, I think, quite obviously is all about tiles and closely associated products that we sell in order to do the whole job, adhesives, grouts, tools, trims, those kind of areas. And then combining that with really, really great levels of world-class service. And we do have world-class service across the business, which I'll come on to explain in more detail. Those two key areas of strength are then leveraged across our three trading businesses as we have them today. So as I went through at the start, our omni-channel business, TOPPS Tiles, our online pure play operations, and our commercial operation Parkside. And then increasing all of that being underpinned actually by environmental leadership. So it's obviously an important area for all businesses. We included a specific element of environment on our strategy schematic about a year ago, I think now. That is an increasing area of focus for all companies. As I said, we also think it's an area where we can genuinely lead our industry, our marketplace, and ultimately can be a source of competitive advantage to the business as well. So on to the first of those two horizontals, as we call them. So leading product as a specialist product is obviously hugely important to us. It really is a key source of our competitive advantage. Global supply chains allow us to generate lots of value in this area, and we think that's quite difficult for our competitors to follow because of the scale point. Supply chains have been really challenged, as I'm sure people will be very, very aware of, been really challenged over recent years. The backdrop for supply chain has got a lot better over the last 6 months. So new product development is a really important lifeblood of our business as well. Lots of the product we sell, we develop in conjunction with suppliers. 35% of the product we've launched over the first half, we've had some element of collaboration with suppliers to bring to the market. We don't just buy product off the shelf from trade shows or direct from factory, and that is also a really important part of our source of differential and our competitive advantage. The business has been expanding into new categories, so we've included some of them on the page here. Outdoor tiles, and these are tiles specifically, so 2 centimetre thick porcelain slabs. Luxury vinyl tile is a whole new category for us as well. That's an alternate form of flooring. And then shower panels, the big sort of single piece shower panels that can do the whole wall in one hit. And also XL tiles, so the sort of super-sized porcelain tiles, which have really emerged as technologies allowed over the last few years, are an increasing trend with customers. And all of that sort of underpinned by an own brand strategy for the business, which is also really important. So this covers both coverings and trade brands. For our trade customer base, I'll come on to that. The brands we have on offer here really help us to drive loyalty with our trade customers. And then for our homeowners, actually, some of the tile brands that we have actually really help to provide assurance to customers in a marketplace where there are very few actual known brands in the world of tiles. So turning next then to leading people. So I mentioned world-class service really is at the heart of everything we do. Our overall, it's a huge source of advantage for the business. The chart, I think, shows a really encouraging, very clear long-term trend of how we continue to strengthen our customer service credentials. So in excess of 90% of our customers score us 5 out of 5 for overall satisfaction. Actually, if you include the 4 out of 5s as well, that would take us up to about 98%. So very few detractors in terms of the customer experience. Very strong achievement here. People availability pressures across the market have eased as well. This would have been a key area we would have been talking about 12 months ago. Vacancies are now actually back to really business as usual levels for us. They were previously elevated for a period of time, and colleague turnover continues to fall, following again a spike sort of post COVID-19 when the employment markets were running pretty hot. We always try and develop our people internally where possible. Cultural fit with the organisation is absolutely key to us because it sort of underpins everything we do. On average, we achieve about 60% fulfilment of roles through internal progression and succession, which is great, something we're very proud of. And engagement is obviously a key stat for the business. About 80% colleague engagement consistently across the business, which also think is a real strength and indexes very well against averages for the UK. In terms of environmental leadership, become a key area of the business, key area of focus probably over the last 2 years, something like that, I would suggest. Scope 1 and 2 emissions, the business currently generates just under 5,000 tonnes of carbon. We've already done some really good work to reduce that number down by about half. We're buying environmentally sourced or clean energy, certainly in terms of electricity. The 2 key areas of emissions in terms of Scope 1 and 2 that remain are generated from our commercial delivery vehicles, so the vehicles we use to deliver product to our stores, and then also gas for heating our stores. We will continue to be sort of very thoughtful about how we continue to reduce our emissions on that basis, but in large part, reality is we're probably waiting for technological solutions here, electric trucks or whatever the final solution in that market is. We've got a really clear focus on two things. One, to be carbon neutral by 2030, and with carbon offsets, we think that we're likely to get there significantly sooner than that. And we're really keen to move on to scope 3 emissions, which I'll come on to at the end. And then circularity also becomes really important to the business. So the simple concept of sort of reduce, reuse, recycle. Tile waste is a key area of focus for us this year. We do generate quite a lot of tile waste through breakages and damage, etc., maybe end of lines, mixed batches. We are really heavily focused on reducing that cost to the business, because it is a cost to the business, but also the environmental impact. We set ourselves a target of 10%. I think we will significantly exceed that this year, and that's going to be a good success. Solar panels, we've just commissioned on our main office and warehouse site in Leicester. It's where the bulk of our operations are housed. We've now, literally in the last few weeks, come on stream. We've now got the capability of generating about 70% of our electricity we use on this site from solar, which I think is really exciting. That will give us about a 3-year payback on our investment as well, which is great. And then scope 3, I mentioned. Scope 3 is becoming an increasingly important area of focus. These are the emissions that happen upstream in the supply chain. So at the point of manufacture and also shipping to the UK, we do have a global supply chain. Early indications suggest that is likely to be the single biggest area of impact, maybe in the region of 10 to 20 times what our scope 1 and 2 emissions are. So that's an area we really want to move on to and give a lot more focus to. On next to the TOPPS Tiles business, the TOPPS Tiles brand specifically. So quick introductory comments. It's our core business, it's market leading, it's an omni-channel specialist, and importantly, lots and lots of opportunity for growth still in TOPPS Tiles. We've been now very successfully serving the customer base across the UK for 60 years. So we're celebrating our 60th anniversary this year, which is something we're very proud of. Our website is genuinely industry leading. We generate about 3 times the amount of traffic versus our next largest competitor. It's a key strength of the operation. Our sales per store per week have really stepped up quite strongly versus 2019, so we're about 30% ahead of that. Some of that has been driven by some rationalisation of stores. You can see here on the top right-hand chart. We've also pushed harder into more of a value-orientated part of our range, and the category extensions I mentioned on the leading product page, a majority of that has been incremental to our sales base as well. So we've seen good success there. And there's also an important reminder that whilst we serve, we need lots of data, lots of store coverage across the UK to serve a trade customer. And we do have a really large part of our sales for the TOPPS Tiles businesses in the trade customer, the professional installer, and we also serve a homeowner. So we're effectively serving two quite different customers from the same roof or under the same roof in TOPPS Tiles. And the next slide I'll turn on to actually explain those differences in a little bit more detail. So trade, super important to us, 59% in the period, average is about 60% over time. So roughly a 60-40 split between trade and homeowner. In the world of digital, really, really important for the homeowner. Again, I mentioned sort of industry leading levels of traffic. We provide a genuine omni-channel experience. For our traders, there's actually much less digital interaction. We have a dedicated trade website, we have trader apps, people can go on and sort of view loyalty points, those sorts of things. But in general, we see the majority of our digital interaction comes through our homeowner route. So 170,000 visitors a week, about 165,000 or 97% are actually our homeowners interacting with us. Our stores are really important for both customers, but when our traders come into our stores, they tend to be in much more purposeful mode. So the 35,000 visitors a week you see on this slide, of our 165,000 overall visitors, and we know that through footfall counters, actually the 20% that represents 20% of our footfall is represented by trade. That accounts for 60% therefore of our sales. So you can see from there, I think, that when traders come into store, they will spend, and they're in, as I say, they're in much more purposeful mode. But online spend therefore for trade is relatively low. And interestingly, when homeowners are buying tiles, and specifically when they're buying tiles, actually the online penetration of the business is something in the region therefore of 18%, which we think indexes very well against DIY, generalists, etc. So 18% online penetration for a homeowner buying tiles. So you can see how important the website is to us and our digital operations. Store teams and service are really important for both customer groups, actually. So we do have very well trained, very high levels of technical knowledge. We inspire our customers. We can support them with technical queries. That applies to both trade customer and homeowner. There are some modest differences, particularly I think things like for the trader, the relationships with the store teams become really important. So these generally are people that are working on their own. They like to come to stores 7:30 in the morning, hopefully get a cup of coffee from the store team. They'll have some social type interaction with the store teams. They have quite strong relationships they form over time, and there's lots of going above and beyond. So a trader on their way home saying, could you get me some of this set aside, maybe wait another 5-10 minutes because I'm running back slightly. I need this for a job tomorrow. We'll always go above and beyond for our trade customers, and they really value that discretionary effort. Brands are very important to our customers, but from two perspectives, actually. The TOPPS Tiles brand, the name above the door, is really, really important to our homeowner customers. This is an infrequently shopped area. That's the next part of the slide. But also it's an area where there are not really any known brands from a homeowner perspective. And therefore they take a lot of trust and confidence from the name that they do recognise. And the TOPPS Tiles brand scores incredibly highly in terms of awareness with the core customer group. So 77% awareness from homeowner of the TOPPS Tiles brand, right up there with the likes of B&Q and Wickes, etc. The next most recognised brand is actually 2.5 times less than TOPPS Tiles score. So you can see there's a big sort of level of disparity between the awareness of brands in the specialist sector. And then for their trade customer, actually, there are lots of proprietary brands that they are very interested in and tend to be very loyal to. So what kind of adhesive you like, what sort of grouts you use, what kind of specialist tools you'll use for your tiling work, and we make sure we cover as many of those brands as possible. Frequency, I just touched on. We'll see traders with a very, very high level of frequency. So our best traders daily in store, certainly weekly, less frequent traders still monthly. So very high levels of frequency there. For a homeowner, they tend to come into this market space much less frequently. So maybe once every few years as home improvement cycles dictate. And price is critical for trade, particularly on consumables. They know what they should be paying. We make sure we keep our pricing very, very sharp. We deliver value to our trade customers through lots of different means. We have standard levels of discount for trade versus our sort of retail price list. We have bulk deals, we have loyalty schemes, lots of ways we provide value to our trade customers, which is super important. For our homeowner, it's more about providing value across the range of their purchase. So often it will be part of a bigger project. They may have a budget in mind in terms of what they want to spend for their tiles, and it's making sure we've got a really great range of product where we can offer brilliant value across the entirety of their purchase. So that covers the TOPPS Tiles part of the operation. I'll then move on to our commercial operation, Parkside. So Parkside really focuses on the sort of B2B market and the commercial market for tiles itself in the UK. The commercial market in the UK is almost the same size as the domestic market, so it is a really important market for us to be in, and it is a market we absolutely should be able to be successful in. The market's still slightly subdued versus sort of pre-COVID-19 period, so about 27% down. That's based on ONS market data. We've established some really strong sector specialisms. We've been in this market now for about 5 years. So infrastructure and travel is a really successful area for us. Things like most of the airports in the UK, we've now supplied tiles to. Increasingly, we're supplying tiles into railway stations, things like high-speed 2 contracts, those kind of areas. We've actually had really good levels of success. And then retail and leisure, things like David Lloyd, we supply a lot of tiles to. People like Soho House are sort of key customers for us. A lot of the sort of casual dining restaurants, you can see Maragami on this slide as well. But the business has been loss-making and has been loss-making for some time. Last year in our final quarter 4, we got the business into break even. We were confident we would be able to stay there. But the sales chart on the page tells a very clear story. We've had half year on half year sales growth. And that obviously gave us confidence that we'd be able to continue to keep the business into break-even and small profit territory. In the first half, we have seen the sales performance of the business step back, declining by about £400,000. On that basis, a loss this year is now likely. And we're very focused on an improvement plan to get that business back into break-even, which is where we said it would be. And the plan is to get there by Q4 this year. The key for me on this slide is the opportunity for commercial remains intact. It is a market I do think we should be in as the leading specialist of tiles in the UK, and I'm very confident we can get the formula right to get us exactly there. In terms of online pure play then, the first of the two businesses we have is Tile Warehouse. This was a new website we launched from the ground up, so an organic startup about 12 months ago. It's the first time we've moved into an online pure play just for tiles only across the business. It's designed to be complementary to the main brand of TOPPS tiles, so it's much more value orientated. It's got a narrower range. TOPPS tiles might be 2,000 tile SKUs. This is about 400. And it's designed to be very much focused on a homeowner specifically, not really looking to attract a trade customer to this part of the business. The first year has all been about learning and refining, so we've been very focused on what is the right digital marketing strategy for Tile Warehouse, what's the correct customer offer that we need to really maximise the return here. The secret to driving traffic is absolutely about pay-per-clicks. It's about investing money in digital marketing, and that does require investment. But ultimately, we believe this is a £15 million plus sales opportunity across the business, and I think can represent a good scale part of our operations. And then on to the ProTiler summary. So ProTiler is a digitally focused or a trade-focused digital-only consumables business. They've got really high credibility with the professional installer base. The co-founders and the people still running the business for us today are ex-professional tilers. They're well known in the industry. It's a very strong brand. It sells everything you need to do the job except the tiles themselves. So the only thing ProTiler don't sell is tiles. They sell everything else you could possibly need. We acquired 60% of it just over a year ago. The first year has been very strong indeed. So about 40% growth we've been delivering consistently over time. It's been excellent. And we will acquire the remaining 40% of the business in April 2024. So it was a two-year deal, and we will acquire the rest of that about a year from now. Really strong growth in the first year, which has been excellent, very pleasing indeed. And also we've brought additional knowledge about trade brands to the business. So they have a very, very wide range of inventory and assortment. Take an area like adhesives, for example, they'll have 14 or 15 brands available, all on a next day delivery cycle. Our core business, TOPPS Tiles, would have 3 or 4 ranges of adhesive available through the store. So lots we're learning there. The digital skill set that ProTiler brings to the business can and is being leveraged further. I'm really excited about that. So the Warm Floor Store webpage you see on the bottom right-hand side of this slide, that's a new business we've launched during the first half of the year, during the second quarter. Very much focused on, as the name would suggest, the underfloor heating market, again with a professional installer in mind. So it sells a range of electric underfloor heating systems, which we've sold across the group for some time, but we've now got a dedicated website. And crucially, it's extended the range into also water-based underfloor heating systems, which we haven't sold previously. We've expanded the range of brands available to us as well. So we've created a real destination for a specialist installer of underfloor heating systems. Very early days, but I'm excited about the growth that can deliver and how we're leveraging our digital skill set across the business. And ultimately, we are very confident that ProTiler can be a £30 million plus sales opportunity for the business. And I think in relatively short order, actually, with the growth we're currently delivering. So in summary then, a strong first half from a trading perspective. I think we've outlined that very clearly. Record ever, 130 million of sales. We've got a very clear goal for the business. I do think we're delivering against that. We're continuing to develop and diversify our business. The group itself is evolving. TOPPS Tiles business continues to evolve, and we're also delivering good levels of sustained like growth out of TOPPS Tiles. And the digital pure play story we think is very exciting. Lots of opportunity for scale and profit upside there as well. As Stephen mentioned, the net margins of these businesses actually don't need to be any different to that which we've experienced historically from our core operations. In terms of outlook, Stephen covered some of these points. Really good start to the second half actually. So our core business, TOPPS Tiles, is delivering in the region of 4% like-for-like sales, as broadly in line with what we saw over the first half of the year. So our consumers continue to remain robust. We are confident of an improved margin in the second half. Stephen's been through that, some really good reasons as to why we do feel the TOPPS Tiles margin has troughed over H1, and the outlook from here is for improvement. Some of those macro challenges we've seen, they are starting to ease, and that gives us a greater level of confidence in the outlook. And ultimately, we're confident H2 will be much stronger, and we will deliver our full year profit in line with market expectations for the year. So that concludes the formal part of the presentation, and we're happy to turn to some questions. Stephen, did you want to
Rob, Stephen, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions that have been submitted today, I'd like to remind you that recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. We received a number of questions throughout today's presentation, and Stephen, if I could just hand over to you just to chair the Q&A, what I'll do is I'll pick up from you at the end.
That's great. Thank you very much, Alessandro. I'll just turn the slides off for a minute so we can get a better view. Yes, okay. So we've had a number of questions. There's actually two questions on a similar theme, Rob, which is for you, really. So the first one is, what's driving the growth at Pro Tiler, and then what potential is there for us to continue moving forward? That's the first one. And then a sort of similar theme to it. We've had a question from Chris T. Thank you for the question, Chris. And Chris asks, how pleased were you with the online PLC performance, and do you see this momentum continuing?
Yes, I think we can sort of roll them in together. I mean, look, Pro Tiler has been a huge success. The business was growing rapidly at the point we bought it. We bought it off about 12 million of sales at that stage. Obviously, we'd come through the sort of peak of COVID and lots of, sort of people switching online. So it was sort of quite difficult to know where we may go next. The guys running it were super confident the trajectory was upwards, and I'm delighted to say they've continued to deliver against that. So what's been the sort of secret sauce over the last 12 months? Well, I think there are three things we've been very encouraging of the team there to do. One is continue to invest harder into digital marketing. We've seen a really good level of return on investment from that additional spend. That's really given us an extra shot in the arm. The second one is investments in working capital. So the business does work on having really good levels of availability. Everything really goes out on a next day point. So we've gone harder into making sure that we've got really good levels of stock density in the business to serve that professional customer base. And the third one actually is access to brands. Now, from two perspectives. So brands, as I mentioned, for a trade customer are super important. There's lots of loyalty into certain types of adhesive or certain types of cutting equipment. From two perspectives. One, we were able to introduce some new brands into Pro Tiler, brands that perhaps they weren't able to access previously, but the TOPPS group can. And secondly, actually, they've been able to go out and negotiate access to new brands to Pro Tiler and therefore to the group, largely though off the back of having the TOPPS group name behind them, actually. So both of those things have been really helpful. Confidence that we can continue to drive that growth? Yeah, high. As I've said in the presentation, I think, we bought it off 12. We're probably currently annualizing at 20. I'm super confident we can get to 30 quite quickly. And the Pro Tiler business itself continues to grow very quickly. And then plus the other activities that we can do, things like warm floor store. Again, very early days, but that's a good size market that we're now accessing from a specialist dedicated platform, which is what we think professional installers want to use. So very excited about Pro Tiler.
Great. All right. Thanks, Rob. Okay. The next question is related to property. We've had a chart about the number of TOPPS Tile stores there were, and the question that's come through is the TOPPS Tile store estate now the right size?
Yeah. Yes. Thank you. The simple answer is yes. So we, at our peak, were about 5 years ago, we're about 370 stores. We did a big piece of analytical work. Actually, we partnered with CACI, who some of you may be familiar with. Did a really good piece of analytical work and concluded that about 300 was the right number. And the way we would get there actually is in some towns where we had smaller towns where we had 2, or larger towns where maybe we had 3. We did some trials and concluded pretty quickly that we could actually trade more profitably from fewer units. So a smaller maybe market town where we had 2, we'd say, well, actually, let's close 1, sort of condense all of our operations into the stronger of the 2 units. We were successful in transferring about 50% of the sales across from the closing unit. So we will have given up some top line sales and therefore some market share in doing it, but ultimately we've made the business more efficient and more profitable as a result. So we arrived at our target of 300 last year. We think it's about the right number. It may oscillate by 5 or 10 over time, but I don't see it significantly changing from there. And back to the thing I mentioned earlier, if we were just serving a homeowner customer, I think that number, maybe could be 100 across the UK. But with a trade customer base, you have to offer lots of geographical convenience. So you do need to be in lots and lots of towns and locations across the UK. And we think 300 strikes that balance very well.
Okay, great, thank you. All right, we've got another question here, which is on gross margins. So in my bit, I talked about our confidence in the improvements in gross margins in the TOPPS tiles brand moving forward. So the question has said, what gives you the confidence in gross margins moving forward? Which, Rob, I don't know if you want to talk about some of the sort of supply chain aspects.
Yeah, thank you. Yeah, absolutely. So, I mean, it's been a very tough time from a supply chain perspective. We run a truly global supply chain is the first thing. So we source tiles probably more than consumable items, but tiles we source genuinely all over the world. We're well known to factories. We've got very good understanding of the global market for supply chain manufacture. It's been a very tough period, particularly in European tile manufacture, from two perspectives. One is European gas prices, as everyone will be familiar, has been a real roller coaster over the last 12 to 18 months. But actually also availability of clay, sadly coming out of the awful events in the Ukraine and the war in the Ukraine. Ukraine's actually a major source of what's called white-bodied clay for European manufacturers. So that also caused quite a lot of disruption to supply chains. And has caused a lot, and both factors, more gas than clay actually, but both factors have caused significant inflationary pressures in supply chain. Shipping was the other one really coming out of COVID. Again, I'm sure lots of people will be familiar with shipping costs were significantly heightened. We went through a period where actually just getting availability of product was a sort of key concern. Price was actually a little bit secondary. We've tried to shield our customers, our consumers from the worst of that. So certainly most of last year, 2022, we were passing cost price inflation on a pound for pound basis. So protecting our profit, but that does mean we have diluted gross margin percentages to an extent. That's how the maths works. This year we've taken a stronger approach, which is to say cost price pressures need to be passed on percentage for percentage. And we're now in a period where we're actually starting to see some easing of those pressures. That does mean we can make sure we continue to offer value to our customers. So we do expect some prices to ease at the customer point as well. But there's also an opportunity within that to make sure we just rebuild our margins a bit back to where we think the longer term trend should be. We're not going to go back to where we were prior to sort of the COVID period, because we have done some strategic sort of realignment of the positioning of the business and margins. But there's definitely some opportunity in the outlook from here, and we're already seeing that coming through in the first half. The other thing we do is we constantly look to sort of resource products. So as the sort of world settles a little bit post COVID-19 and other events, we can and will and are doing looking at sort of global opportunities. So countries like South America, Brazil specifically. 10 years ago, we sourced quite a lot of tiles from Brazil. 3 years ago, very little. Actually, things like Brazil are coming back on our radar again, and we are sourcing back there because of shipping rates and manufacturing costs. India has actually gone through a period of some factories have invested very heavily. Most tiles in the end are manufactured on Italian equipment. It's not really a labour model, particularly. It's about well-invested modern manufacturing facilities. India is an increasingly interesting area for us as well. We're getting really good quality tiles at advantage rates. So lots of opportunities. Our buying team are working very hard to make sure we continue to offer great value to our customers.
Great. Thank you very much. I think the next one's more one for me. So someone has written in and asked, can you explain the difference between adjusted and statutory profits in the period? Yes, I can. Thank you for the question. So I'm just going to pop the slides back on for 1 sec, because there's a slide that deals with this directly. Hopefully they've come back on for all our viewers. So in my section, I was talking about the adjusted profit before tax of £4.4 million in the period. If you look at the face of the P&L statement in our results, you'll see that the statutory profit before tax was £1.7 million. What we do in common with a lot of companies is we take out items which are either very volatile or non-cash or non-reoccurring, and we sort of strip them out of the adjusted profit before tax number. The reason for that is to present a more consistent view of profitability over a period of time that sort of aren't distorted by sort of odd events. And so the three things that have been removed this time round are the three adjusting items in the table. So I'll just quickly touch on each one. So property, we just talked through the reduction in the store estate in TOPPS tiles, going down to 304 stores at the end of the year. And that closure program, the costs associated with that, so for example, the cost of dilapidations, the cost of strip outs from stores and so on, those have been adjusted out of our adjusted profit number. So that was £0.6 million in the half. Now that that program has ended and we're now kind of at the right level of stores, those costs will start to go back into the adjusted profit before tax moving forward. The next thing is that when we were describing the Pro Tiler purchase, Rob said that we bought 60% of the shares last year and we will buy 40% of the shares, the remaining 40% of the shares next year. The way the accounting for this works under IFRS 3 is that we have to build up a provision over that 2-year period, so between when we bought 60% and 40%. So that is a charge that you'll see in every 6-month period up until the end of that 2-year earn-out, which ends in March 2024. So in this period, there's a 1.7 million charge relating to that. And then finally, we tend to strip out any restructuring costs, which were 0.4 million pounds in the period. So those are the differences between adjusted and statutory profit before tax in the period. So thank you for the question. Hope that was clear. I'll just take the slides away. Okay, next question we've now got from Tom M. So thank you, Tom, for your question. And the question is one for you, Rob, I think. It says, what visibility do you have on the delayed projects that impacted the revenue in parts time?
So, I mean, the commercial market does work much further in advance. I think that's absolutely right. So typically we might, if we're sort of in at the ground start point for these projects, they might be coming out of the ground in 12, 18, even 24 months. And tiles are obviously sort of right at the end of the project. The sort of heavier side of the building materials will be at the early point. But the reality is at the point we actually take an order, those orders probably turn into sales in about 3 months' time. So our visibility of the outlook is perhaps not far forward as people might expect. Where we are currently is we expect the second half to continue to be a little subdued still and a bit tougher as the first half has been, which is why we're really focused on that business improvement program that we've talked about.
Great. All right. Thank you, Rob. That's brilliant. And then another one, which I think is more in my area, from Chris T. Thank you for the question, Chris. And the question is, what's your capital allocation policy with regards to share buybacks? So yes, good question, Chris. Thank you. So if you go back 1 year, so to the interim results from 2022, we laid out a new capital allocation policy, an updated capital allocation policy for the business. And there were 4 things in that capital allocation policy, and sort of 4 priorities really for us in terms of how we think about cash and capital allocation. The first one is business resilience. Having just been through a pandemic, we're sort of more conscious than ever really of the importance of having great resilience in our business. We are quite a operationally geared business in the sense of we have quite a lot of fixed costs. So therefore, as the sales line changes a bit, our profit can move around quite a lot. So therefore, that means even more so really than some other companies. I think we need to have quite a lot of financial firepower to give us that really good resilience to protect the business moving forward. So that's always going to be the first thing that we prioritise. The next thing is that we will always continue to invest at an adequate level in the existing business, and particularly in TOPPS Tiles, which, as a reminder, is sort of 90% of what we do. So to keep a good level of investment behind TOPPS Tiles will always be right up there in terms of capital allocation. It's not a massive cash draw. I think we're guiding to £5 to £6 million of capex this year, but we will always prioritise that in the group. And the third thing in the allocation policy was to do with new value creation opportunities. The acquisition of Pro Tile is a great example of that. So having some cash available to go and do things such as buy a new business that we think we can really add some value to and can add value to the group, I think is always something that we will want to be able to do and have the flexibility to do. And then finally, returns to shareholders, I think, which is directed to Chris's question, really. So as part of that, we signalled the increase of our dividend payments to shareholders. Our previous policy was to pay around about half of our adjusted EPS out to shareholders each year. And if you go back a year, we signalled the intention to increase that to 2/3 of our adjusted EPS we'd look to pay out. So we've actually increased our dividend payments to shareholders, which I know is very important to quite a lot of viewers on the call, really. So I think hopefully that's a really positive sign. In terms of things like share buybacks and returns of excess cash to shareholders, again, if you look at the statement last year, we outlined when we might start thinking about those. So we have about £20 million of cash in the bank, but we also do have a lot of commitments, particularly around leases. So if you look at our balance sheet, we've got about £100 million of lease liabilities on our balance sheet. So if you include lease liabilities, we actually have a net debt in the business of about £80 million. So it's not, and those are commitments that we've made, and we can't walk away from those. So when we think about level of cash in the business, I think about lease adjusted net debt, which is about £80 million, and then I compare that to our lease adjusted EBITDA. And what we said in the policy last year is that if our lease-adjusted net debt got to the point where it was less than 1 times our lease-adjusted EBITDA, then we would look to return that excess cash to shareholders. That could be in the form of share buybacks. It could be in the form of special dividends. You know, I think that probably remains to be seen. We're a little bit of a way off that at the moment, but I think, you know, hopefully there's a clear signal of how we might think about that moving forward. I hope that answers your question, Chris. Thanks for the question. And actually, I think that is actually the last question that we have at the moment. So I'll go back to you.
Perfect. Rob, Stephen, thank you very much for that. I think you actually addressed every question from the investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Rob, could I just ask you for a few closing comments?
Well, I suppose firstly, thank you, Alessandro, for hosting. Thank you to our viewers for joining us today. It's our first time on the Investor Meet platform, so hopefully this is a good thing that we can continue to build and attract more investors to the story. Hopefully you've got a really clear view of the story. So really good first half, record level of sales, really strong trading across our key TOPPS tiles, our core TOPPS tiles business as well. Lots of opportunity for further growth. TOPPS tiles continues to grow. We're really excited about the online pure play story there as well, and the continued growth of Pro Tile and Tile Warehouse over time. And we think a much stronger second half is coming than the first half, and remain very committed to those full year expectations in the market. So we think the outlook for the business is strong. Thank you.
Rob, Stephen, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of TOPPS Tiles PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you.